Hello and welcome to this installment of the Ask Alan television program, the show that discusses issues in wealth management important to you and your family. Our topic for this installment is business succession planning. And to help me discuss this issue, I'm joined by local CPAs Bob Ramsey and Mark Kassen. Bob, Mark, welcome to the show.
Thank you, Alan. Glad to be here.
Great, glad to have you on. And I always like to give my guests an opportunity to share a little bit about their backgrounds with our viewers and the services offered by their firm. So Bob, we'll start with you.
I am a native of Wayne County and a graduate of Indiana University and Centerville High School, and have been in the Richmond area practicing the CPA profession since 1987.
Great. Mark?
I graduated from University of Alabama in 1992 after growing up in Liberty, just south of Richmond. Came to work in Richmond with Olive LLP under Bob's tutor in 1996, and then moved to Indianapolis in '99 with the same company, and moved back here to rejoin Bob in 2001.
Well, tell us a little bit about your firm.
Well, we have about a dozen people on staff at the office, and we're really run a full-service accounting firm, as I guess it would be described. With we offer accounting, financial statements, bookkeeping services, income tax planning preparation to businesses and individuals, estate planning, business valuation services, many of the things that you'd customarily see with most CPA firms.
So it really is a full-service firm.
Absolutely.
Great. Well, let's go ahead and get right into our topic. And in preparation for the show, I was doing a little research and was a bit surprised to see just what a large percentage of businesses in the United States are family-owned. There's over 20 million businesses in our country, and over 90% of those are family-owned businesses. And even more surprising to me was the fact that with the Fortune 500 companies, a third of those are either family-owned or family-controlled. So clearly you have a lot of businesses in our country which have a family owning them, and that family has to figure out, how do we keep this business going on after we're gone? And that's really the heart of the business succession planning. So Bob, we'll just throw the question out for you. Just what is it meant when you say business succession planning, and why is it so important?
Well, it is certainly important. We'll address a couple of those things now and obviously throughout the program, but business succession planning really should be the course of action that a business owner or business owners take to successfully transition ownership and management of the business from one group of people or one person to another person or group of people. Again, the key word there being successfully. We all certainly hope that it is successful, and with proper planning, I think it can be done that way. It's really critically important because so many of those millions of businesses that you referred to that are closely held family businesses have their greatest challenge is going from either one generation to the next, if the business will stay within the family, or if it's not going to remain in the family, finding a way to have an exit strategy so that the business owner can receive the benefits of his or her hard work over the years, and make that transition to a new management team.
And that's going to happen because they can't work or live forever.
That's right, in spite of all of our best wishes.
Exactly. And I'm sure, Mark, that there's a variety of issues involved in the process of planning the succession of the business, tax issues, if the owner also has managers that help run the business, the emotions the owner have. How do you see those all tied up into the planning process?
Well, it really depends on the individual involved. Each business succession plan is going to be a little bit different. We're dealing with different businesses and different personalities, And each time the business owner has a different set of objectives, we're going to have to change our priorities to meet those objectives. So the tax planning is certainly important on just about every aspect of the plan. When you have top ordinary rates of 35%, and most small businesses will fall into that top ordinary rate of 35%, the next one down to 33%. Then you deal with capital gain rate of 15%. There becomes surcharge basically of 20% that you're paying or voluntarily paying if you don't adequately plan for the tax consequences of a sale or a transition. In the management issues, if you have a good management team in place, that certainly is important. If you already have it in place, you don't really have to plan for it anymore other than to plan for the handoff to them, the transition to them. And then with the emotional issues, you have to get into the mindset or get the business owner in the mindset he's going to have to give up control. And eventually he's going to have to step aside and realize that he's not going to be the one making the decision. He's going to have to let someone else step up and make the mistakes and put in the sweat equity that he has throughout the years. It's time for him to step back, or him or her to step back, and to realize that it's going to be an ongoing business. That's the whole point of this, hopefully, is to have an ongoing business without them in the forefront. And
that's true even if their name's on the building, right?
Absolutely.
And speaking about the tax ramifications, I would also imagine estate tax will come into play in some instances.
Sure.
If they're trying to pass the business on to family members, how can they, how they'll have to do that in the most tax efficient way? Do you see that coming up occasionally?
Yeah, absolutely. And usually what happens too is that most of the small business owners are not diversified. I mean, they've put everything they have into this business. They'll take some out to pay taxes, and they'll leave the rest in to build the business and continue to build the business. They might have a salary that comes out, but usually that salary is pretty modest. I mean, they're not really paying themselves fair market value for what they're doing for the business. There's a lot of sweat equity involved that they're not getting paid for. And what happens is that their entire estate is basically the small business. Then the issues become, how do we take care of the other people in the family who aren't involved in the small business? If we're going to transition the small business to a couple of the kids and a couple of the other kids aren't involved, how do we equalize that? So there becomes some issues in how to equalize the estate, which most people like to do. I mean, there's certainly exceptions where there's families that they don't really want to equalize the estate, but most of them they do, and there's ways to fix that and to equalize that. But it needs planning to be done, right? You can't just wait until the last minute or wait until it's too late to do postmortem planning and think that everything's going to be equal when it really can't be. Or
expect that your children or spouse will all agree on how things should be divided up with the business. And I would imagine right here in Wayne County, Bob, that a lot of the businesses are small, family-owned businesses. Many of them are your clients. So what is the role that your firm plays in putting together a business succession plan, and what are kind of the steps you take when you're putting a plan together?
Well, certainly one of the first questions, I think, as Mark mentioned, there's many just an endless number of circumstances when you're dealing with closely held businesses, and really any business for that matter. Facts and circumstances are so important to the equation. But one of the first things we're looking at is whether or not the business is going to attempt to be retained in the family. And certainly in a lot of cases there are family members who want to be in the business and who have grown up working in the business, or maybe have moved away for a while and then come back and want to become involved in the business at a later stage in life. When you're dealing with family transition, you kind of go in one fork in the road, and that sets a certain course of action in place. If you're not looking at a family transition within from one generation to the next, then you're looking to transfer ownership to key employees possibly, or looking to recruit some key employees so that 2 or 3 years down the road, maybe that person will be ready to take over the business, be willing to buy it, and pay the owner fair value for the business that's being acquired. What we're trying to do is help the owners see those options and potentially obstacles to to making a successful transition. The worst thing that can happen is for the subject not to be discussed and or thought about. So we act maybe, I guess, as a prod from time to time to get people to think of the issues. It's always easier to sort of defer the subject and well, we'll deal with that maybe next time we get together. But really, the sooner that one can start thinking about it, the more effective the plan's going to be. And so that's really what we try to do first. Secondly, we will help people plan for the financing of it. Obviously, as Mark mentioned, there's a lot of tax considerations. We certainly try to minimize the tax consequences in any of these types of transitions. Those are the roles that we really play, including some help with business valuation issues, which I think Mark will talk about a little bit more as well.
That's a good segue into just the ways that the owner can exit the business, which might be part of the succession plan. And just to kind of follow up on that, I know one of the ways they can exit a business, Mark, is through selling it to the employees through like an Esop, an employee stock ownership plan. Have you had experience with owners of a business wanting to pass it on through selling it to the employees?
A very few number of times, and the reason for that, and I'd probably say that that's normal for this area, is that the ESOPs are so heavily regulated, and there's so many hurdles that you have to cross over to become an ESOP, to be recognized as an ESOP by not only the IRS, but then your valuations are governed by the Department of Labor. So you have two albatrosses on your back from the get-go of this. But basically it's a qualified plan, it's a pension plan, so you have to meet all the regulations involved in Section 401 of the Internal Revenue Code, which are pretty serious. You have ERISA there, you have the IRS on your back, you have DOL, and there's just a lot there. Before you even start, you should probably get a private letter ruling to make sure that all your T's are crossed and your I's dotted.
So someone who wanted to do that would have to really be committed to doing it and have a really good reason to want to get the employees involved as owners.
Yes, and not only is the employees being involved in owners a good part of the ESOP, but there are some tax advantages to selling it to an ESOP. You can defer the gain on your sale proceeds if you reinvest it in marketable securities, if you meet certain requirements. And there's requirements that you have to meet in every step of the ESOP. But if you can pass those hurdles, they're usually worthwhile if the dollars are right. So where it can be fairly substantial tax savings for the business owner.
And I guess another way to transition out of the business would be to just sell it. And Bob, if you would, talk a little bit about how you might have management buy the business from the owner using loans or installment payments as a technique to exit the business.
Well, that's probably one of the most common exit strategies that we see outside of some of the family transitions. But we're frequently looking at maybe a management buyout, which again may be one person, it may be more than one, but key employees who have been working in the business for some period of time have gained, of course, the trust of the current owners, gained the trust and respect of the customers, suppliers, etc., that are involved in the business and making it successful. Frequently, the owner or owner group is going to have to help finance the deal. Most of the time, the key employees have not, while they may have been fairly compensated and well paid for their services, they probably haven't been able to sock a lot of money away to just sit down and write a check or go get a multi-million-dollar bank loan to finance acquisition of the business. So that the owner is typically going to have to be involved in helping with the financing package, particularly if he or she wants to try to maximize their selling price. If the prospective buyer is going to get outside financing and or put his or her own money into the deal, substantially anyway, they're typically going to want to try to cut down that selling price a little bit. So we generally see the exiting owners be involved in the financing of it in some manner, and usually, as you mentioned, with an installment obligation, some sort of payment period over time that, whether it's 5 years, 10 years, whatever that might be, agreed upon between the two parties. That's a quite common, maybe the most common exit strategy we see.
And then, Bob, another option, I guess, would be to sell to an outsider who's not part of management or the ownership
Right.
of the company. And how does that typically work?
Well, that in a lot of cases, that will we'll see a strategy of that, of just going and trying to get either maybe going through a business broker of some sort, where you sort of put the business up for sale, much like somebody might put their house up for sale, advertise it, send out prospective information pamphlets about the business, a lot of promotional literature and financial data that would be sent to selected interested parties, possibly even to get involved in to a certain extent an auction process with obviously a very select group of prospective buyers.
Not on eBay, for
not likely on eBay, no. Although I suspect it's been done,
yes.
and or will be.
Everything has been on eBay, I think.
That type of a deal, while the bidding competition might help the owner realize a larger selling price for his or her enterprise, in most cases, it's not going to be as large as the selling price might be to what I would call insiders, key management group of people who might be willing to pay a higher price for the business because they're comfortable with it. They know the bumps and bruises. They're not as worried about some of the unknown issues that an outsider might be. So, frequently an outside sale to truly an independent newcomer to the business is probably not going to result in as high of a selling price to the exiting owner, but we do see many situations like that, and it's usually one where you try to get at least 3 or 4 or 5 parties involved trying to bid for the business.
I would imagine too, if you have a business that's so small that you don't really have any management, it's perhaps the husband and the wife and a couple of employees. There's no real management layer. Selling to an outsider might be the best option that they have.
In many cases, it may be one of the only options they have, yes.
And of course, we all know that oftentimes the business owner will try to get the business to family. They may have children who are active in the business, or children, as we mentioned earlier, who are returning to the community and want to get involved in the business. Mark, how do you see a business owner wanting to get the business to family members? They might approach you and say, hey, I want to give this to my kids, or I want to leave it to them through a bequest. How does that fit into the plan?
Well, it does fit into the plan, absolutely. It's part of the transition of the business to the next generation or next generations, if it is an ongoing enterprise that many generations are going to be involved in. If the eldest is an older child with children of his own, then they can fold them all in and be involved in it. What can happen is that they can use annual gifting to gradually gift over the business to the other generations, and then whatever isn't out of the estate by the time the business owner passes then is transitioned through to the survivors, either through a buy-sell that's in place or just through the testamentary provisions of the will. So it's all there, it's all in writing, everybody knows what's going to happen before it happens, hopefully. That's part of the plan, is to have everybody on the same page so there's no infighting when it's all said and done, and no one's trying to one-up everybody else to try to get a bigger piece of the pie. But if the lines of communications are open and everybody knows their place when this is all parsed out, then it's going to work better for everybody.
So it's really incumbent on the business owner to make sure those things get put into place so you don't have family squabbles 20 years later over who's going to get the biggest share of Dad's company.
Right. The squabbles will probably still happen, but we can at least try to minimize them.
And then I guess another option would be to sell the business to the family member. And what kind of issues pop up there? Because I would imagine, son might think Dad ought to sell it at a heavily discounted price because you're the son. But how does that usually work, Bob?
Well, you're absolutely right. That brings in a whole host of other issues potentially, and a lot of times we'll see one of the other things that comes up in that regard, or maybe that not forces, but at least encourages a business owner to look at the sale transaction, is in response to one of the issues that Mark mentioned earlier, and that is how do I equalize my estate? The vast majority of families that we talk to, they want to generally treat their heirs equally, be it typically the kids, and very often all the kids are not equally involved in the business. Some of them work every day in the business, some of them are in other states, so they're not involved really at all. And a sale of a business to one or more of the children who are involved will usually then allow the owner to have the selling proceeds, cash over time, that he or she receives for the sale, that then can be doled out through the wills or trusts that they might have in place to transfer their estate. It's a much easier to transfer ownership in stocks and bonds and cash accounts than it is in a closely held business. So hopefully it will mitigate some of those concerns that a business owner might have about how we're going to equalize things among people. But you do then certainly get involved in the issue of the pricing, and that's one of the things that we try to help with in terms of getting a reasonable valuation that hopefully will be satisfactory to both parties, and yet also keeps that family equity concept in mind, so that the siblings who are not involved in the business don't feel like their brother or their sister got a sweetheart deal on the sale and really got a free pass or an extra inheritance, if you will, because we certainly don't like to see situations where what has once been a very cohesive, hard-working family unit then starts to self-destruct due to some of these financial concerns that come up in the second generation. And that's why you talked about some of those statistics earlier with family businesses and how many of the businesses in our country are family-owned, closely held businesses. The percentage of those that successfully transition from one generation to another is remarkably small. And hopefully, with information like this about business succession planning and emphasizing the importance of the process, I guess one of our goals and objectives would be to try to see that percentage go up over the years.
Absolutely, and I guess to come back to a point you made there in your answer, one of the key components of any sale is putting a fair value on the business. And what are the things you do when you are looking to value a business? What are the factors that you look at, Mark?
Well, really you're looking at how much would somebody come in and buy this cash flow from me? How long would it take for someone else to come in to put their money at risk? What would they expect to get for that money investment? How much of a return would they get for the risk they're taking on? And how long is it going to take to get that return and their money back? So you have to value the business individually. There's no general market rate. There's no multiple that you have to put to revenues or profits or whatever. There's no easy way to do it. It's not a cookie cutter that you can just put the type of business in, the revenues in, and all of a sudden you get a value out. It has to be an individual look at the business, and you value the customer base, the vendor base, the revenues that you get, the workforce in place, the management in place,
inventory,
fixed assets, intangible assets. Everything is on the table in evaluation. And what usually happens too is that these businesses, when they're sold, they're not sold. You're not selling the stock like you would on Wall Street. You're not selling a bulk of stock. You're selling the assets of the company. You're selling what's inside the stock. So you're left with proceeds within the company. They're not really buying the entire company from you. They're buying the ongoing business, really. Then you're left with the stock in your hands. They're not taking all the liabilities from it. They're giving you cash for your assets in the business. So each individual business is going to bring a little bit more to the table than the one before. You can't really go to your competitor and say, how much did you sell your business for? How much did you buy this business for? Because that competitor could be completely different. If that competitor only has 5 customers and you have 25 customers that provide a small amount of sales per each customer, whereas the other competitor has a concentration of sales to one customer, that competitor is going to be riskier investment. Because what if they lost that one customer? Well, if you lost one customer, it really wouldn't hurt you very much. So there's risk involved in your broad customer base, and that risk is really what's valued as well, and that comes down to a fair market value.
And when you're doing evaluation, typically how long does it take to complete it?
Oh, a pretty good while. We usually say that we can get one done within between 30 and 60 days after we get all the information in. And there's a fair amount of work that needs to come in from the business owner as well. We need anecdotal evidence. We're not just looking at a balance sheet and figuring up a value from your financial statements. We need to find out what really goes on in this business. There's so much that goes on that isn't presented in financial statement form that we really need to find out how it works, how the business works, how do you do your job, and put a value on how you do your job and how you run your business. That's what we're trying to accomplish.
So it can be quite labor intensive on your parts to drill down to get all that information that you need.
Yeah, it is.
Well, Bob, in the couple minutes that we have left, I'd like you to speak to the importance of the business owner getting objective advice when they're thinking about how to pass the business on, and who do you think should be part of that team that's giving advice to the business owner?
Well, it sounds obvious to say, but it bears repeating, and that is it's extremely important, in our opinion, for a business owner to get some objective advice. That information can come from their legal advisors, banking relationships, bank advisors, lenders, CPAs. Those types of people are going to be well informed about the business in most cases, have long-standing relationships with the business owner, and hopefully are willing to provide open and honest information to the business owner. What we'll do with that is take and try to encourage the owner to look objectively at his business and help him derive at whether he wants to go in the direction of his family, whether he wants to go in the direction of his employees, evaluate those people. Can they take the business and take it another generation? Just because they've been good employees doesn't mean they'll be good owners. And that's a critical decision for him to have to make when he's evaluating that group of people. So hopefully by assembling a good team of people around him or her, the business owners can make some of those tough calls that need to be made when they're looking at starting down the road of business succession planning.
Great. Well, gentlemen, this has been a very informative discussion. Bob, Mark, I thank you for coming on the show and sharing these insights. And viewers, thank you for watching. I hope you've enjoyed the program, and we look forward to broadcasting another one to you soon. Thank you and goodbye.
You're watching Whitewater Educational Television, Cable 20, a service of Whitewater Community Television.